Hi guys, my name is Prosper. You're welcome to FS Global Forest Trading Academy. Here, once again, this is our Forest Mentorship course. Today, we're going to be looking at these topics: order block, fair value gap, supply and demand, mitigated and unmitigated order block, supply and demand flip, understanding who is in control, continuation, entry. Order block. Other blocks are candles where market makers, that is the banks, place their positions. Research has shown that market makers do not trade manually, but algorithmically. Over 90% financial institution traders use algorithm in trading. Thus, prediction of market buyers is done based on signatures of operation models of this algorithm without greed, fear, and emotion. One of the ways to achieve this is through the application of order blocks. Order blocks are candles where market makers, banks, have placed their positions. Price returns to those candles and they are never violated. The market is engineered by smart money by means of creating levels within the marketplace for them to use at a later date and time. An order block can be identified by specific candlesticks or bars that, when properly viewed in institutional context, can highlight smart money buying and selling. Apart from commonly used supply and demand zones, order blocks have very specific levels that can be refined on lower time frame to exact price levels. When the smart money traders want to inject money to the market, they don't do that randomly. They do that by means of making use of order blocks. And these order blocks are simply signatures that have been created by algorithm in the market. And these market makers or smart money traders take advantage of these order blocks to place their position. We have the bullish and the bearish order block. What is the bullish order block? The bullish order block is the last bearish candle, before the bullish movement that breaks the market structure higher. The candle represents a high possibility of holding the price when the price returns to it. The bullish order block is the last bearish candle before the bullish movement that breaks the market structure higher. Now, for the bearish order block is the last bullish candle before the bearish movement that breaks the market structure lower. The bearish order block is the last bullish candle before the bearish movement that breaks the market structure lower. I'll pull off a chart here to show us exactly what an order block is. Now, if you're looking at this chart here, we can see exactly that there was a move. There was an impulsive move from here down here. But before this move was engineered, there was a bullish candle. The last bullish candle, which is this candlestick, this last bullish candle before this bearish move, that is your order block. In this case here, it is the bearish order block. Then again, here again, we'll have a bullish impulsive move here. Before this bullish movement was issued, there is a candlestick. The last bearish candlestick before this bullish move is your bullish order block. Now, it is on this candlestick that the market makers take advantage of to place their positions. And price always return to these order blocks or candlesticks that serve as order blocks. And most of the times when price returns to this order block, they are not violated. That means they tend to hold price when price returns to this order block. So your job as a trader is to identify these order blocks on your chart, then look to place orders at these points of order blocks. How to identify the correct order block? How do you identify the correct order block? You need to ask yourself some questions when you think you have identified an order block. What are these questions you need to ask yourself? What confirms or what makes up an order block? One, is there a break of market structure after the order block is formed? That means for an order block to be confirmed, the order block has to break a market structure. Second, does a candle after the order block engulf the order block? That means the candlestick that was formed after the order block candle, is it an engulfing candle? Did it engulf the candlestick that serves as the order block? Thirdly, how big is the wick of the candle after the order block? After the order block, the next candle, how long is the wick of the candle? Then fourthly, has the order block mitigated yet? The other block, has it been mitigated yet? These are the four questions you need to ask yourself when identifying an order block. So you're going to go right away to pick up a chart and identify the other blocks. Try to refine these other blocks to lower time frame. Then look to see if these other blocks actually actually obey these four questions, actually give answer to these four questions that needs to be asked. Now I have a chart on Euro, GBP, USD. Now, for you to identify your order block, you need to make use of higher time frame. Possibly you start from your daily time frame. Possibly you start from your daily time frame. So quickly, I will be identifying the order blocks on this chart. This is on my daily time frame. This is on my daily time frame. I'll try to identify these other blocks on this chart. Then when I'm done with identifying these other blocks on the daily time frame, I'll come over to 4 hours time frame, see how I can also refine these other blocks on 4 hours time frame. Okay. These are the other blocks I have here for now. Now, for this particular one, which is the last one below, this here is the last bearish candle before this bullish move. So this is the other block. Now the question is one, the candlesticks. The question is one, did the other block break a market structure? Did it break a structure? Let's see. Now this is a structure here, this high. You can see that it broke a structure. A structure has been broken. Now, at the moment when this high was taken out, it means that the structure has been broken. This means that this other block has broken a structure. That is one of the questions answered. Secondly, the candle that follows the other block, is it an engulfing candle? Is it an engulfing candle? Let's see. Of course, this is an engulfing candle. This engulfs this bearish candle. So it is an engulfing candle. It's an engulfing candle. Let's go ahead. The next question, let's see what it is here. How big is the wick of the candle after the other block? All right, let's see what happens here. All right, the candlestick here do not have a wick. So that question here do not apply because it doesn't have a wick. You are still going to look for a chart of one that has a wick. Then thirdly, the last one, the other block, has it been mitigated yet? All right, now this is a topic we are yet to come to, but I will throw light on it here. Now, an order block is said to be mitigated. An order block is said to be mitigated when price has returned back to it. An order block is said to be mitigated when price has returned back to it. Another block that price has not returned back to simply means that the block has not been mitigated. Now, for this particular other block here, price has returned back to it. So this is a mitigated order block. This is a mitigated order block. This order block is mitigated. But for this particular one above, the one above it here is still unmitigated because price has not returned to it. So since price has not returned to this other block, it is still unmitigated. So an other block that price has not returned to is an unmitigated other block. And the one that price has returned to is a mitigated other block. Now, for a mitigated other block, you don't look at taking orders or placing orders at a mitigated other block. The other blocks you look at taking or placing orders at is an other block that has not yet been mitigated. That's an unmitigated order block, and the other blocks you can take or place others at. All right, good. I believe we are getting something here. Now, when to use weak as zones or other blocks. Now, note this. Textbook told us or tells us that a bullish order block is the last bearish candle before the bullish move, whereas a bearish order block is the last bullish candle before the bullish move. But it doesn't apply that way. It must not necessarily be the last bullish candle before the bearish move or the last bearish candle before the bullish move. No, that rule do not apply all the time. Most times, other blocks can be a candlestick of the same color, bullish, bearish, bearish. Now look at this scenario here. Let me use this diagram to explain what I'm trying to say. Let's look at this scenario here. If I am to identify my order block here, using by the textbook definition of order block, I will use this candlestick, this last bullish candlestick, as my order block. Am I not right? Yeah. I'm going to use this last candlestick here as my order block. That is, this particular candlestick as my order block. But that is not the order block here. That is not the order block. Now, because that is not the order block, that is not the last candle before the impulsive move. The last candle before the impulsive movement was this particular candle. This was the last candle, or this is the last candle before the impulsive movement down that will serve as the order block. But even in this scenario, this particular candlestick is not the order block. Why is it not the order block? Because of this wick here. Remember the third question asked to perform on order block. It said, what is the size of the wick after the candlestick that forms the order block? Now, in this case, because of the size of the wick of this order block, we are not going to use this last bearish candle as the order block. Rather, we'll use the wick. The entire wick of this candlestick serves as the order block. The entire wick of this candlestick serves as the order block, which is exactly what happens here. All right, so I believe this diagram is self-explanatory. Most of times, the order block must not be the last opposite candlestick. No, it may be a candlestick of the same color. And also, when the wick after the candlestick that is supposed to be the order block is longer, you use the wick of the next order candlestick as your order block. All right. Trading with order block. Or before we come to here, let me go back to a chart and let me complete this chart here. That is still on this chart, trying to identify order block on this chart. We're still on it. This is I'm using this week here as a order block. All right. This is I'm currently on the daily time frame. All right, this is all I could get on daily time frame. Now I'm stepping to my 4 hours time frame. Going to 4 hours time frame. On the 4 hours time frame, I will try to refine these order blocks. Refining of order blocks simply means adjusting the order block to suit the candlestick on that particular time frame. When I am refining my order block, I'm adjusting the order block to suit the candlestick on that particular time frame. So this, I am refining this order block here to this. I have another order block here. I'm gonna use this wick below here as the order block. Okay. Now this, yeah, I have this as an order block here. You can see exactly what I'm doing. I am simply refining my order block. Then I have this. I have this as my order block. Then this was the one I have on daily time frame. Then I refined this here. If you look closely, you can see here that I'm using the last candlestick of the same color as my other block. All right, let me see if I can let me see if I can scroll, go back. Okay, I am still refining. I am still refining. This is on 4 hours time frame. All right, you can see exactly what I'm doing. This is simply me refining my other block. I'm simply refining my other block. All right, this is it here. This is what we have here. This is what we have here. We have both the mitigated and unmitigated order block. All right, mitigated is an order block that price has not gotten to. So when after I refined, I have a lot of unmitigated order blocks. Let me judge with this current one here. This is an order block that's unmitigated. This is another unmitigated. Now, having unmitigated other blocks here simply means that I am expecting price to come to this other block. All right. When the price comes to this other block here above, I will look for a sell opportunity. And when I sell here, I'm going to sell to target my profit on this particular other block. So the price list comes to this other block, mitigates it, and once it's coming down, it is coming down to this other block to mitigate it. All right, good. So we now know how to identify our other block, how to refine. Now, I am stopping, for the sake of time, I'm stopping this refining of other block on the 4 hours time frame. Okay, you can go as low as 1 hour, 30 minutes, 15 minutes, even up to 1 minute, depending on how you trade, depending on the strategy, depending on the time frame comfortable for you to pick your orders from. Okay, all right. So this is how you identify your other block and refine your other block. And I believe at this point, we already know what a mitigated other block is and what a non-mitigated other block is. Okay. How to trade with other block? You start with higher time frame. H4, me, I prefer starting with daily time frame. Then from there, you refine to 4 hours time frame. 1 hour and lower as you can go. Select another block with the most body and not weak. All right, this is exactly what I did practically. When price is retesting another block, expect a price to bounce off at higher of bullish other block or lower of bearish other block. But middle of the other block is the last point of retracement when looking for entries. If price breaks the other block, then find another other block. Now, what does this mean? What does this mean? When price is coming to the other, let's say price comes to this other block, you expect to get your entry between this point of this other block and the middle of it. And the middle of it to get your entry to go down. But if price breaks through this other block, I don't know other block is break proof. All right. If price breaks through this other block, all right, the other block has become void. Then you look from that one. That's exactly what that statement there means. Just like other natural support and resistance, before trading to the actual order block and reverse, most of the time, price will fake the reversal, then continue an order block. Now, let me try to explain what this means. Now, if you look closely here, let's say this happens and price is coming down, right? After this other block, there's another one down here. Now, because of this other block down, price may get here. Instead of holding price and moving it back up, market might come to this other block, break through it, and come down to this one. Then this is the one that will hold the price. All right. So that is exactly what that statement there means. Stop loss is just above bearish order block and below bullish order block. Now, if you take an order from here to sell, or from here to buy, as the case may be, your stop loss here, your stop loss is above this other block. For this here, your stop loss is just below the other block. about 5 pips or 10, 5 to 10 pips below and above the other blocks, as the case may be. When trading with other block, use other indicators. All right, most times you do not trade. Of course, whatever pattern you trade, you do not trade it in isolation. You try to combine one or two other things to trade the other block with. All right, as we program, I'm going to tell us or point out to us some other things you combine other blocks with to trade with it. Okay, I'm going to point it out to us as the class progresses. Always cut through the candles in the current price range and see if there are previous other blocks on the left, because these levels are important. Always cut through the candles in the current price range and see if there are previous other blocks on the left, because these levels are important. Now, what does this mean? Okay, like in this scenario here, there is an other block here. Right? Which price has broken, price has broken through this other block here. Yeah, in this case, price has broken through this other block here, but this is another block here. Now, this point, this other block did not actually hold the price. It did not actually hold the price. Now, this does not mean that in the future it will not be relevant. This other block may still be relevant in the future. When this happens, for instance, and price happens to come down, it may not come down to this immediately. It may come down and stop here. All right, I will not be surprised when this happens. Let me extend this other block. Price has already made this other block void, but most times this other block may still be very, very important. Now, instead of going upstream, price may first come down, do this. Stop here before going up, then returning back here. I see what I just did. Now, this may happen because of this other block here. So most times when price has cut through a particular other block, those other blocks may eventually end up to be useful in the present. All right, so you always try to take note of other blocks that has already been rendered void, because they may come in handy. All right, good. Fair value gap. Fair value gap. A fair value gap, short for FVG, is formed when the market moves rapidly and leaves a gap between wicks. The gap between wicks is called inefficiency. Price usually fills the created gap to restore balance. Assigning FVGs and combining them with supply and demand zones can make you avoid lots of early entries and can save you from unnecessary losses. FVG has a lot of synonyms. FVG can also be known as imbalance, gap, inefficiency, unfairness. Now let's look at what this means. Now, when it comes to candlesticks, when they move, they don't leave space behind. What do I mean by that? Look at this. Between this candle, this week and this week here, there is no space left behind. Between this one and this one, there's no space. Between this and this, there is no space. Look at here. Between this candle and this one here, this week and this week here, there is a space. There's a space from here to here. From here to here. This space is what they call the fair value gap. Now, when gaps like this are being created, market will always come back to fill these gaps. All right, we have other block. Let me see if I can zoom in a bit. This is a gap. This is another block here, but there's a gap here between this week and this here. This is what is called a fair value gap. This gap from here to here is a fair value gap that needs to be filled. This is a fair value gap. This is called FVG. FVG, this is a fair value gap that needs to be filled. Whenever you see a gap like this gap simply means that the market will eventually come back. It may not be immediate, maybe sometime in the future, sometimes it happens immediate. Price will usually come back to fill up this gap because this is called trade imbalance, inefficiency. So gaps are not supposed to be left between wicks of candlesticks. So no matter how small a gap is, it is always filled. All right, it's always filled. Now look at this again. There's another gap between here and here. Is a gap. This is a gap that needs to be filled. You know, I did mention that price will return back here. What is bringing price here? What to make price will come back to this other block is one reason, which is one, there is an FVG here. This FVG needs to be filled. All right. This FVG is what is dragging price to come back down. And what will make price to go up here is because if you look here, there is an FVG here. There's a gap here. Okay? There's a gap here. Between here and here, there is a gap that needs to be filled. Now, this gap here is the reason that is pushing price to come to that particular order block. That particular order block is attracted. You know, just like when you drop sugar, or when you drop grains of rice, and there's a hen beside that hen will always follow the drops of grains or rice dropped on the floor. Same thing happens with the market. When the market moves, the market do not move random. There's never a random movement in the market. There is not a random movement in the market. Every movement in the market is always thought out as a predetermined or a thought after move. All right, something is attracting the price to move in that particular direction. Now, whenever you have a fair value gap, an FVG, this is what attracts price in a particular direction. And whenever you see an FVG, there is an order block, either before, most of the time before that FVG, there is always an order block. All right. So that is it about fair value gap. Hope we understand this. Supply and demand zone. Supply and demand zone are the same thing as your order block. It is just English. It is the same thing as your order block. It is also the same thing as your regular support and resistance. The same thing as your regular support and resistance. Now, let's do this. Supply and demand zones are areas in the market in which price shows signs of weakness, exhaustion, and reversal. Supply and demand can also be seen as zones where price rapidly pushes away from. Where price rapidly pushes away from. They also know as could be fair value gaps and break of market structure or change of character. Supply is your regular resistance zone, whereas demand is your regular supply. Supply is your resistance, demand is your support. Supply is your resistance, demand is your support. Supply is your resistance, demand is your support. Factors to consider when mapping out a supply or a demand zone. What are the things we consider? 3 things to consider when mapping out a supply on a demand zone. One is, did it create an FVG? That is your supply or demand, which is the same thing as your order block. Was there an FVG created after the order block? Was there a fair value gap? When you find when you see a fair value gap, find the last candle before the fair value gap. That candle is your order block or your demand or your supply. When you see a fair value gap, find the last candle before that fair value gap. It is your demand or supply zone, which is the same thing as your order block. It must not be the opposite candle. It could be the same candlestick, just like I explained earlier. Okay. Now again, that one is sort of when you get identify that demand or supply zone, which is something as your order block. All right. Did it break structure? Was there a break of structure? Or, excuse me, was there a break of structure or a change of character? Then thirdly, did it create liquidity before the zone? Was there a prior liquidity created before the zone? We're going to look at these three things being underlisted here. Let's go to chart. You know, I like being practical. I like being practical and realistic. Now we'll have a fair value gap from here. Okay, let me do this. I'll use this chart. I have a chart I'm gonna use to make all this explanation clearer. Now this is a chart. I have a chart here with other blocks drawn up. You can see the other block, identifying the mitigated other blocks and the unmitigated other blocks. Mitigated other blocks and the unmitigated other blocks duly highlighted. Okay, now let's see here. Going to zoom out a bit. Let's see here. Here we have, or we had rather, an FVG here. There's an FVG between here and here. Fair value gap that was created between here and here. Now this FVG, the last candlestick before the FVG here is your other block, which is this. All right, that's the other block. Now this other block, they did break a structure. You know, you are still talking on how to confirm an other block or demand or supply. They're the same thing. This particular other block I'm talking about is a demand. Okay, it is a demand. Did they break a structure? Yes. This is a structure here. This is a previous high. Here, this is a break of the structure. So the other block broke a structure. All right, it has broken a structure. That other block, was that an IFC? Yes, there's an IFC. Was there another block? What that other block was? Did it form an IFC? Yes, there's an IFC. IFC is the same thing as FVG. Okay, it formed a fair value gap. Did it break structure? Yes, it broke a structure. Now, this you can see what pushed price back down here was not just to come and tap on this other block, but price has to come and fill up this fair value gap to tap into this particular other block. Okay. You can also see some other blocks or demand zone that have been identified here. You can see this place here. This is an other block. In this case, it's a demand, but it's your support. This is another block. Is there an FVG here? Yes, this is an FVG. From here to here is a fair value gap. They did break a structure. Look at the structure. Yes, there's a break of market structure. I hope we are getting something here. Trying to make this as simplified as possible. Okay. This is another FVG. This is another fair value gap here. Another block here. Is there an FVG? Yes, there's an FVG here. Did it break structure? This high has been broken, so you broke a structure. Now price has to come down to fill up this FVG and tap on the other block. Another FVG here. Yeah, the other block here, this other block. Did it form an FVG? Yeah, this is an FVG here. Did it break structure? Of course, that this structure here, it broke this structure. All right, are we getting it? All right, how do you identify an other block? What makes an other block? One, the other block must break its structure. Then it must form an FVG, fair value gap, which is the same thing as an engulfing candle or an IFC. It must form an FVG. An FVG has to be there. Then it must break a market structure. These are the things to consider when identifying an other block. And man, remember I told you that your demand and supply is the same thing as your other block. Your demand is your normal support. Your supply is your resistance. Okay. It's just these are diagrams to point the same thing I just explained with a chart. It's a diagram to point the same thing I just explained with a chart. Okay. Talking about mitigated and unmitigated other block, I've already explained this at an earlier time. All right, a zone is unmitigated when price has not tapped into it. But the moment price returns and taps into the zone, it becomes mitigated. Now let's do this. Let's use this chart to explain this further. All right, take a closer look. We have some other blocks here. I think this chart is self-explanatory due to the fact that it has been duly labeled. This is another block here. This other block has been mitigated. This one has been mitigated here. That's been mitigated here. Now, this particular other block is not yet mitigated. That means we are expecting price to return to it. This is unmitigated. That means we are expecting price to return to it. This is also unmitigated. We are expecting price to get to it. This is also unmitigated. We are expecting price to get to it. All right. A mitigated order block is another block that price has returned to. Another block that price has not returned to is an unmitigated order block. Now, talking about mitigated and unmitigated order block, when price comes from an unmitigated order block. Now, let's do this. Now, we understand what an order block is. We understand what a fair value gap is. We understand what a mitigated and non-mitigated order block is. That is good. Now, when price is coming from an unmitigated order block, I'm going to explain this in detail, making use of this chart. Now, I'm going to paint a picture, making use of this chart. Now, at this point, this is an order block here. This is an order block here. All right, this is an order block, and price just left, market left that order block, and it is heading up. Market left that order block, and it said, look at price left this order block here, and it's going up. Where is it going to? It is coming to this order block to mitigate it. Now, listen to this carefully. When price is coming from an unmitigated order block, when price, let me see if I can zoom out a bit. Good. Okay. When price is coming from an unmitigated order block, in this case, price is coming from here to this order block. It's coming from this particular order block down here, which is not yet mitigated. So it is coming from an unmitigated order block to this one that is unmitigated to mitigate it. When price comes here, you cannot sell immediately. Once price starts into this other block, you sell. No, 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 and no. You cannot sell immediately because price is coming from an unmitigated order block. What do you do? When price comes to this other block, you are going to wait for what is called a change of character. A change of character or a flip. You should wait for this. Price has come to this other block. It has mitigated it. Wait to get something like this. All right. Wait to see first. Wait to see first a pullback. Price came from this other block down here, up here. Wait to see a pullback. No matter how small that pullback is, then a return. It may come to back to this other block or even go in like this. There has been a flip. Now, once a flip like this occurs and it starts coming down here, you have your entry to sell because there has been a change of character. The flip can come in different variation. Market can come here, do this, all right, then down. All right, at this point here, you can sell and push the market. You can sell and push the market right down because there has been a flip. There has been a change in character or a flip because price is coming from an unmitigated order block. Are we following? Good. Now, but let's assume that price comes from here. Let's say that this has happened. Got a flip. Price coming from up now. This other block has been mitigated. So price is coming from this other block down to this particular other block here. With this, you may not need a flip or a change of character because price is simply coming from a mitigated other block. For that, when moment price touches here, it guarantees you a go ahead to buy up. It guarantees you a go ahead to buy immediately because the price is coming from a mitigated order block. So when price is coming from an unmitigated order block to another order block that is unmitigated, when price gets to that order block and mitigates it, you do not enter the market. You do not place an order. You have to wait to see a flip or a change of character before you can place an order. But when price is coming from a mitigated order block to an order block that has not been mitigated, the moment price touches that order block, you can execute an order for either a buy or a sell, depending on the direction the price or the market is coming from. All right, good. Okay, that is basically everything we are saying here. Now let's look at this here. All right, price came from this other block here to this particular one here, but price go through it, breaking through this other block here, going up. All right, there has been a flip. There has been a flip. So coming back down here, you get an entry to buy. Okay. Now look at this. Price came from this other block. It's not mitigated, but it did not get to this one here. It did not get here. It stopped halfway. Stopping halfway simply means that this is a demand. Simply means that demand is in control. When demand is in control, you are buying. You know, this is your support. This is your support. Demand is support. So at demand, you are buying. It means that demand is still in control. That means buying is still in motion. So the moment price did not touch that other block, it stopped halfway, then came back down here, you can buy. You can buy because demand is still in control. Demand is still in control. You can buy because demand is still in control. You can buy to take your profit here because this other block here was not hit. Okay. All right. I think this actually explains it in a bit. Now look at this here. Look at what happened here. Price came from this other block that is unmitigated to this one. To this one. Mitigated it, you do not have a sell entry here because price was coming from an unmitigated order block. You do not have a sell entry. Okay, you are not selling because price came from an unmitigated order block. Now, the only time you're considering a sell is look at what happened afterwards. Price came here. You see, there has been a flip. There has been a flip here. Now you can now sell down. There must be a change in character. Let me use this chart to explain it again. Let me use a chart to explain it again. There's a chart to explain. Look at this. This chart explains it. Again, price came from this other block, which is unmitigated. So this one here that is yet unmitigated and mitigated it, but you cannot sell. You cannot sell. You cannot sell. Now look at what happened. It came back down, returned up. This is your entry for sale. Returning back to this other block again, there has been a change in character. There's been a flip. There's been a flip to the character here. Here you can sell. You can sell from here. When you sell from here, coming down, When sell from here coming down, you're targeting your profit on this other block here that has not been mitigated for you to take your profit. I think this explains the issue of who is in control. Now let me rephrase it. When price is coming from an unmitigated order block to mitigate another order block, you do not get an entry for either a buy or a sell until there has been a change in character, a flip, before you can confirm an entry. Then, when price is coming from a mitigated order block to an unmitigated order block, was price mitigates that order block, you can buy or sell instantly because the price was coming from an unmitigated order block. But I believe it makes sense. Okay. Demand flip, supply and demand flip is just change of character. That like it's just change of character, like what happens here. This is what I mean by a flip. A flip is exactly what happened here. What happened here? Price came from here, came here, no entry. This is a flip. Is a flip. I've given you a change of character. The price market has changed its direction. It's not coming down. This is a flip. So when you hear demand or supply flip, that is what it means. And you are looking for a flip or a change of character, especially when price is coming from an unmitigated order block to another unmitigated order block. All right. When price is coming from an unmitigated order block. Now look at another one. Even when the market came down here, market price came from this other block here that is unmitigated. So this one here, it mitigated it, but no entry. Then price went up. When price went up, look at what I mean by exchange of character. This here is a structure. So when price went up, it has broken this structure. Broken this structure is your change of character. It's your change of character. It brought structure to the upside. Then return back down. It gives you your entry here for a buy. For a buy. The one above also, look at it. Price came from this other block to here. Then the change of character, look at this low here. The low was broken. That is the change of character. So going back here, it gives you an entry here for a sell. That is just the way it works. Very simple. So this is another chart that explains this. Price, let me talk with the correct market price here. Price here came here. Price market came from this particular order block here down to this other block here, which is yet unmitigated and mitigated it. There is no entry, no entry here. Then when price went back up here, market went back up, going up here, see change of character here. Price went up here to this other block. Remember, this coming from here again, there's a change of character here where the structure was broken. Good. When price went up here, it gave an entry here for a sell. So you can get a perfect entry here for a sell to push it down to take your profit on this other block here that is not yet mitigated. Okay. So when you enter a market from an order block, from a mitigated order block, you are targeting your profit at an unmitigated order block. When you take your profit, when you enter the market from a mitigated order block, you are targeting your profit at an unmitigated order block. Okay. This is virtually everything I've explained earlier for us. Now let's look at this chart. I want to use this chart to summarize almost everything we talked about. Order block, FVG, demand and supply, same as order block, who is in control, and what have you. Now let's look at this. I will start from the beginning. Price left this place, this point here, went up. Yeah, here there's another block here. There's another block here. This is another block. Price left this other block, went up. Okay, went up here. This. There was a lot of activity around here. Then price returned to this other block. Price returned to this other block here. Give an entry for a buy. When you buy here, you're targeting your profit here. When you buy at this point here, you're targeting your profit on this next other block above. Now, market moved from here to this point. Now, when market moves, what happened? Market, this card here, there are FVGs here. FVGs here. Now, this FVG here simply means that price has to return back to fill up this FVG. Now, market came down, fill this one and this one. Came down to here, filling these FVGs, all right? Filling these FVGs. Now, when price came down here, it's not giving you an entry, but this other block is not mitigated. So when market went back up, by the time it went back up here, it has now mitigated this other block, giving you an entry for sell. Selling, you sell down there to take your profit here at the point where this other blocks is being mitigated. Because I want to help us look at the market clearly so that when you are reading the market, you should understand exactly what you are doing. Then market proceeded again, there came down to this other block here that has been here for some time, which is yet unmitigated. Price came down here. But then coming down to this other block, the market left FVGs, fair value gaps here. That needs to be filled. But the market played up around here and returned back up. What returned the market up is not because it just wanted to go up, because this FVG has to be filled. So price returned back up with the intent of filling up this FVG. But in going up, the other blocks you have above, this one is already mitigated. This one is already mitigated. The only one that is not yet mitigated is this particular one here. That is the one that is not yet mitigated. So when price went up, it broke through all these other blocks, thus making all of them void, then came to mitigate this one. But mitigating this particular one, look at what happened here. It gave us a change of character here. If you look here, what we have here is what I've mentioned yesterday, failure swing. I say failure swing does what? Gives us a bearish reversal, failure swing. Now, in going up here, a lot of FVGs are left here. When I say FVGs like this, I see money that needs to be made. Fair value gap. From here to here is a gap. From here to here. From here to here is a gap that needs to be filled. From here to here. Then from here to here is another gap that needs to be filled from here to here. So these gaps here simply means that market needs to come back down to fill these gaps. And if price is coming back down, this other block here have been mitigated randomly. This one is already mitigated. The only other block that is not mitigated is this one below. This one is only one that is yet unmitigated. That was why when price started coming down, it came down straight, covering all these FVGs, covering them until it gets to this other block and it's mitigated this other block. And having come down this far to mitigate all these other blocks here, to mitigate that other block, filling up all this FVG, something else happened in the course of price coming down. What was that happened? What was that happened? Fair value gaps were left. See gap from here to here. This is a gap. This is a gap. This is a gap. Whenever I see gaps like this, I'm always happy because this is money to be made. This is a gap. So there's a gap from here to here. From here to here, there is a gap. We are seeing that. Now, this simply means that price has to return up. And when the price returns up, where is it going to head to? When it returns up from down here, it will cover this gap, cover this one. Where will it fall to? It will come to this other block here to mitigate it. But now, where is it coming from? It's coming from this other block that has already been mitigated. When it gets here to mitigate this particular other block here, without thinking twice, I am selling down. And when I sell down, I'm selling down, targeting the next other block around here that was created in the movement up. Okay? So with this, I believe we understand what other block is, how to identify other blocks, how to refine them, how to know the mitigated and non-mitigated other block. We've also gotten to know about our supply and demand. Supply and demand is the same thing as your order block. It's just that for the bullish order block, the bullish order block is called supply demand, which is the same thing as your regular resistor support that you know. The demand or the bearish or the bullish order block issues a bullish movement. Then the supply is the same thing as your bearish order block and also the same thing as your resistance. Let me make it clearer here so that we don't confuse. Demand is the same thing as your bullish order block. Bullish OB is the same thing as your support. It is just English. Supply is the same thing as bearish order block. It's the same thing as your resistance. All right. So it makes sense. We shouldn't confuse it. We shouldn't confuse it. They are all the same thing. They are all the same thing. Okay. So we know what a mitigated order block is and what an unmitigated order block is. I also know how to take entries based on order block mitigation. When price is coming from an unmitigated order block to another unmitigated order block, you look for a change of character. That is, a change of character simply means a break of structure in the opposite direction before you confirm an entry. But when price is coming from a mitigated order block to an unmitigated order block, you may not need a change of character. You can execute a trade, whether you buy or sell instantly. All right, it is quite simple. Going forward, we have continuation entry. Continuations are very simple and an easy way to scale in orders. Once again, we do not care about structures. All we care about is a break of the most recent minor supply or demand. What does this simply mean about continuation entry? I'm going to explain this with a simple chart. I'm going to explain it with this chart. What I mean by continuation entry. Now, when the market moves, look at this movement here. If you look at this move, this movement from down here to up here. Okay. Let me show us how this movement took place from the bottom. Now price left here, came up. When it came down here, it formed an other block. All right, the other block was confirmed by the break. The other block was confirmed by the break of this structure. And you also left FVG here. The market later returned back to fill. And the time price returned back to fill this particular order block, right? He gave an entry here for a buy. He gave an entry here for a buy. You give an entry here for a buy. Now, as a trader, you may not have seen this entry. You may not see this entry, or you may not see it when it happened. But market continued, went up again. Came down here, it broke, it formed another block. Why was this place confirmed as another block? One, this is FVG. Two, it broke the structure. So whenever price returns to this particular order block, to fill that FVG and tap to that other block, you get an entry for a sell. What am I saying? When price eventually in the nearest future returns back to this other block, you get an entry for a buy from this. All right, but you're still looking on how to join in this movement up. You're looking on how to join this movement up. Now, I'm talking about continuation entry. This is another other block here that was formed. Another block that was formed. Then when this happened, this is a mitigation of this other block. This means that this here has to be mitigated and not unmitigated. Didn't see this initially. Now, when this other block was mitigated, this gave you an entry for a buy. It gave you an entry for a buy. You bought. Now, when you bought here, this market went up. When it went up, you also gave another entry. So we say, where is the next entry now? Look at this. There is another block here. Whether you like it or not, there's another block here. Did the other block break structure? Yes. Look at this structure. It broke this structure. So at the time price returned to this other block, this gave us another entry for a buy. You see, it has given you one. The first entry for a buy was here. So here we have entry 1. Here we have entry 2. Here we have entry 3. This is a continuation entry. Entry 1, entry 2, entry 3 at this point. Then again, here is another block. There's another block here. We go to on forward time frame. When you take this chart to 1 hour time frame, you will see another block here. This week here is another block. What confirmed that was another block? Did it break structure? Look at this side here. It broke structure. Then when the price returned to it again here, gave another entry for a buy. So this is the 4th entry. So if you miss the first entry, you're not going to miss the second one. You miss the 3rd one, there's a third. You miss the 2nd one, there's a 3rd one, and also a 4th one. So these are what are being referred to as continuation entry, when a setup gives you multiple entry. But for you to be able to spot out these entries, you need to be very agile, very careful, to look at the market closely. Try to understand everything you are seeing. Try to read the market clearly, and that way you can see a valid entry at any point in time. This is another chart here that explains continuation entry. The other chart that explains it. Market came all the way from down here to this place here, but in the change of character, it flipped. So when these structures were broken, it gave a change of character, but not an entry. So market came here, gave me this other block here. It gave me this particular other block here. Then this other block broke a structure here. The market came back to this other block. This is the first entry it gave here. Now, if you have missed this entry, they gave other 2 entries. This is the entry 1. Another other block here, but price did not return to it, so no entry. But when it went up, this is another block here. Did it break structure? It broke structure. Even left IFC, FVG like this. So when price returned to ETI, gave you second entry, entry two. It continued again on that other block here. Did it break structure? This high was broken. That's the structure. When price returned to it here, it gave you another entry, entry three. You see, these are what are being referred to as continuation entry. If you enter the market from here, the targeted profit here at this other block. So the forex market is very, very simple and easy. All you need to do is to understand the market, be able to read the market. And where is your market reading starting from? The origin is when you start identifying your other block. You start from your daily time frame, identify your other block, and know that the other block may not usually be the opposite candle before the bullish or bearish move. It may be the candlestick of the same color, or it may also even be the wick or the candlestick, depending on how long the wick appears. It can also serve as an order block. You can refine to whatever time frame you want to be taking your entries from. Refine your order blocks to lower time frame by adjusting the order block on candlesticks on lower time frame. We're trying to note all the conditions that confirms an order block. It must create fair value gap. It must break a structure. Those are the things that confirms an order block. And also noting the mitigated and unmitigated order block. Mitigated order block is another block that price has returned to. Unmitigated is the one that price has not returned to. Then when price is coming from an unmitigated order block to another unmitigated order block, you have to wait for a change of character, which is simply a break of structure in the opposite direction before you can take a trade. Then when price is coming from a mitigated order block to an unmitigated order block, what do? You simply take a trade instantly because the price is coming from an unmitigated order block. All right. So this is it here for order block. So I believe everything about order block has been understood. Everything about fair value gap is understood. Order block mitigation and unmitigation, demand and supply flips, then continuation entry has been well understood. Thank you very much. All right, and see you some other time. My name still remains Prosper, your instructor.